Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for May 4th, 2013. We have a market that's back into bullish normal conditions on an annual basis with weekly RSI 14. It's at 72 out of 100, so slightly overbought in the green. On a 10-day basis, due to the gap up on Friday and a nice close, we're oversold. Well oversold on a 10-day basis using the 10-day NDX with a score of 126, which means that if you took the previous day's 10-day trading range and then took 26% of that range and added it to the previous high, that's how high it closed, that's how high the breakout was. So quite a significant statement on Friday based on an unemployment report. Looking at the market mosaic, the percent stretch relative to the 200-day moving average is back into green bullish at 10.93%, leaving the 200-day moving average behind. The slope of the 50 has improved up into white bullish at 0.58%. ADX has increased now above 15 to 15.3. That's considered a strong sign for potential next leg of the trend because it was below 15 with bears in charge, and now it's above 15 with bulls in charge, so a transition in market state potentially signaled by that change in the ADX. ATR percentage has pulled back to 1.03. The VIX index, or the risk index, which is the 30-period moving average of the VIX divided by the 10, is now 1.02, which puts us back into risk-on conditions. The z-score of that number of 1.02, looking at the last 5,000 days, is 0.15. You can see the time series here of the last 90 days and how we've had a period of increasing volatility down into risk off territory. It came down to -1 on the z-score, and like clockwork is now moving back up, and that's favorable for the long side. The 26 and 13 ETF portfolios are identical this month, with Japan, U.S. real estate, and Australia owned in both, with the next reevaluation due on or about 1 June. Theoretical exposure in ETF 2 is at 90%. The model portfolio remains at 100% exposed, with just a need to update some stops in that system. A couple really excellent, I think, modestly, a couple good case studies uploaded at the YouTube channel during the week. Next up is just a quick look at the current listing of the ETF portfolios for blended monthly. You can see mid caps with their strong showing on Friday moved ahead of Australia in the list, but otherwise it's Japan, real estate, mid caps, Australia. Only Latin America is now on a cash position. It's interesting to note that the emerging markets have now, as of Friday, crossed back above their 4-month moving average, so this could be time for the globals to start playing catch up again. Inside the 26 ETFs, you notice the list of symbols that are still on cash position: Brazil, Latin America, the BRICS, emerging Europe, China, agriculture, gold, and meanwhile it's now Japan, financials, U.S. real estate, mids, and Australia among the top 5. Let's see. Looking at the market health check now, the vertical blue lines are 10, 20, and 30 days worth of look back. Let's zoom that up a little bit. The purple line is the new swing high at about 162, which took out the previous one, which was around 160, which is now a support line here, this thin red. So what was once resistance may now become support, so be watching that carefully. But to me, the real support is under this support level here, back at the Bollinger Band mean around 158. The horizontal red lines are previous support levels that have held. The dark blue in the middle is the 30-period Bollinger Band plus or minus 1. The lighter shaded area called the floodplain is the Bollinger Band plus or minus 2 on a 30-period look back. You see this little oscillating line here. That's the slope of the 30-period regression line and it's measured against this scale over here. You can see it's been positive for the last 4 months, so it means the slope has always been up, but it's now had a period of recovery and is now beginning to move out again. So there's room to believe that there's legs on this upward move. If it can hold this above this support level at 160, that would be awesome. The black thick line in the middle is the 30-period regression line. That slope is what's plotted as a time series on this, by the way. Peeking out of the corner down here is the 200-period moving average, and the red shaded area is the region underneath the 200. These thicker black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period. And you can see right now we're pushing the boundary of the upper regression line channel. We're well out of the river, well out of the floodplain, above the previous swing high, pushing that new swing high. So let's see if there's any legs on this. In Williams percent R, the market's been overbought for about a week now. It can stay that way a long time, as you noticed, during the entire bullish move up. When it goes below minus 80 here on these in a bull, that gives us those swing trade patterns in channeling and usually overreaction. You can see percent price oscillator has the jaws open to the upside. Still plenty of room for it to go and continue up. So that scenario that we talked about last week may still be in effect. We're looking at the ETF2 regional indexes now. 9 out of 10 are on a buy position, which puts us at 90% invested, 10% cash in the theoretical model. In the when we look at the regions right now, SPY at 67 strength is slightly better than the globals represented by EFA at 66. So the U.S. is still marginally better than the rest of the world. Inside the U.S., it's mid caps, then large caps, then small caps, then tech, still being weighed down by Apple. The two strongest ETFs right now remain Japan at 82 and mid caps at 67, followed by and then the two weakest are Latin America and emerging markets, still at 52 and 55 respectively. Looking at the world market model, the U.S. remains all above average, as is Europe. Japan is exceptionally above average. Asia less Japan above average. Philippines, Thailand, and Indonesia continue to provide some leadership, as does Australia. Latin America and the other emerging markets, though, and the rest of the Western Hemisphere all below average. The private equity ETF still doing well, along with U.S. real estate. Oil has made a little bit of a rebound, but gold and silver continue to lag, as do treasuries. In the business sectors, again, you can see that's usually the U.S. business sector in charge, although the globals are starting to catch up, and there's a number of ties, like in materials, industrials, tech, and healthcare. Right now, the strength is in the U.S. on these defensive plays like staples, utilities, healthcare, and consumer discretionary. Healthcare seems to be the place to be, and that's strength in Pfizer, Merck, Johnson & Johnson, for example. ETF top 30. These are all with average volume greater than 100,000 shares and sorted by the strength column. The leaders continue to lead, and that's Japan, biotech, solar, more Japan, Philippines, Pacific Index, natural gas, more biotech, healthcare, S&P retail, believe it or not. So all of these that are green in strength and white in consistency, which is the 10-week moving average of strength, are all doing relatively better and are starting to accelerate because they're pulling away from their 10-week average. Those that are green and green are the ones that are fully valued and have been leaders for a long time. So right now, solar and the Pacific Stock Index are ones that ought to really get your attention. Looking at the Dow through the same lens, Hewlett-Packard has resumed its position at the top with price now back above 20. Boeing, Disney, Verizon, American Express. Microsoft on the move up here, again in green and white, and DuPont, Coca-Cola, and Intel. Those four right there are the ones where I would be looking at as the emerging leaders now. Those that are green at the top are fully in the leadership position, have been there for a while. And then you can see Pfizer has backed off a little bit, although its consistency, its 10-week average is green, its current strength is in the white, and so it's moving down the stack. Only Caterpillar now remains exceptionally laggard. Alcoa has moved out of the red into the yellow. GE and IBM here, when they're white on consistency but yellow on relative strength, that's a sign of real weakness right there. And ETF liquidity, just for your reference. We'll take a look at the daily report now. No signals in channeling or in overreaction. You see the time series on the risk index just nudged into the green here and risk on. You can see ADX has bottomed out, and now the bulls are firmly in charge. Couple pattern trades in channeling and overreaction for Pfizer and Merck, and then 551W for Travelers and Treasuries on a triple screen. And in the auto framer, these all test out at better than 2 to 1. Dow tactical summary. Merck should be of interest here. It was a % loser on Friday, had a 7 on RSI 2. None of these test out better than 2 to 1 on the auto framer here, simply because with that very large gap up on Friday, there's no real measurable gain to the 10-period or to the 10-day high as a frame of reference for targeting swing trades. So we're definitely in breakout and potential runaway positions here. It's hard to calibrate upward moves in that area using that standard auto framer methodology. So what we were interested there really are who are the leaders. And on Friday it was Caterpillar and Alcoa, which is interesting because you'll recall those were the two at the bottom of the stack, and so in the Dow, and have been for the last 8 weeks. So one of the things we like to pay attention to then are the extreme conditions for extreme moves. So here's a case where you had extreme winners like Pfizer and Merck and United Health and JP Morgan were all the % losers on Friday and actually lost money, whereas the two that had been the bottom of the Dow, Caterpillar and Alcoa, turned in really strong moves of 1.9 and 3.2% respectively. So that's why it pays off to attend to the extremes. Can't predict which way they're going to go, but that's where you're more likely, in my view, to get extreme moves. Among the ETF 30, it's the same issue. The flight away from risk and into risk on really penalized the VIX and treasuries and agriculture and favored the inverse VIX. And the only pattern trade here is in treasuries on a triple screen. See the 30-period regression line and the breakout above the 10-day trading range, why that's such a potentially significant move. The slope of the regression line is crossed over this week. It's a 10-period moving average, right around the 6-month average of that slope, and is now pointing upwards. There's room for it to go still on the % stretch, 2 to 3% to just get to the 6-month, to make a new 6-month high on that indicator, and that would get us up to about 165 in the S&P. Fail stat, just for references, and now I'll just flip through these without commentary. Notice the continued strength in Microsoft. Again, that's this little Z swing indicator has really helped us zero in on where the real strength has been. You can see even S&P technology working. Japan continues to work. Looking at the Z-scores of the 90, 30, and 10-period regression lines, you have the 10 had come out of the plus or minus 1 channel. It's now back into it. The 30 is still rising. The 90 is well above the channel, and that's really on the basis of those two longer-term ones is the what I see as a potential for the next leg up. If you look at the price with respect to the river in isolation. Here you got 1, 2, 3 legs up and possibly the start of a fourth leg now that it's taken out that previous swing high. Failure of that, though, brings it back to about 154 pretty quickly, and then we would think that looks like an aging bull. But otherwise, until further notice, though, it still looks like a green light and smooth sailing ahead. Gold made a nice sharp recovery. Try and find bullion and coins in the physical to own. All of my usual dealers are out or have stocks are delayed. And so while people who own the paper asset have been shaken out of their positions, it looks to me like people who take a longer view and want to own the physical asset are taking advantage of this as a buying quality at a value price. And that's what I'm doing. Frog quality numbers. And just flipping through. Let's take a look at the quality reports just for the heck of it. Things that I'm looking for here are short-term pain. This is interesting. Intel has been the worst on the last year in terms of system quality, but has turned in a 30-day performance that really is powerful. Disney has gone really. This is nice on Disney, where it had green on the long term and now green on the short term. That's excellent. What you'd look at if you're looking for buying on pullbacks, Travelers and Pfizer, and especially Pfizer, has been among the leaders on the months -1 to -12, but then in the last 30 days have been lagging the rest of the Dow, and so that's a potential buying value on dips or buying strength on dips. Those that are really doing well, though, are things like Microsoft had been red over the last 12 months, but now it was white over 2 months ago and then green over 1 month ago. That's a sign of acceleration, and that if you want to do a quick look at that divergence, the difference between the 30-period quality score and the long-term quality score is in this column, and so those that are in green have the greatest divergences. So we'd be looking. That would lead you to candidates that are long-term pain and short-term rebounds. Intel, Microsoft, DuPont, Boeing, Walmart, and Disney, all of which have been value plays that have been marching up the Dow table in the blended monthly rebalancing lens. So that's a reason to take a close look at those. Whereas something like Travelers, you can see the steam is really coming out of that. So it's not moving up, but it's kind of resting on its longer-term strength. So if you're looking for the early value rebounds, that you'd be looking at the 30 to 264 divergence. If you want more of a tactical play, you'd be looking at the 30-60 divergence. 30-60 is the difference between these two quality columns. The 32-64 is between the first quality column and the last one, the 12-month versus the 1-month performances. So that's everything from Tortoise Capital for this weekend. We'll see you in the chat room and on the weekend webinar. I think we're going to be prepared for more swing trading ahead on the long side, while respecting the profits that we've been able to book on the shorter term trading. So take good care, keep your powder dry and your risk measured.